Welcome to Money Convos, where we discuss personal finance and investment tips. We're committed to helping people create wealth and achieve financial freedom. Follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. All right then, let's head into today's conversation.
Hello, everyone. Welcome, Courage. I've invited you up. Mimi inviting you up also. Alternatively, you can request the mic and I bring you up. Great. Hi, Mimi. How you doing?
I'm good. Hi, everyone.
Hi, Mimi. How's the week going? I was having a conversation with someone this morning, and it seems that tensions are really high in Ghana. How's it going?
I think it's not helping because now you have to talk to, like from my side, you have to talk to a client. You don't even know what to tell them. If things had been concluded and then you know what, because you don't want to say something and then the person will come back and say, but you said this and the opposite happened. So it makes, advisory and selling a bit more difficult, but yeah, let's see what happens.
I see, but beyond the professional side, how are people in Ghana generally feeling?
Well, I don't know about people, but I mean, yesterday I was trying to research on how to survive economic collapse. So I don't know if people, but I guess people are what I gather is that people are how do I put it? Like people are getting scared. Let me put it that way. I was saying the other time that someone called me about SNIT. Will he get his SNIT pensions and the rest? I had to explain how SNIT works for him to calm down. That is a defined contribution. Your payments are made based on those of us who are actively working now. So yes, the SNIT it has invested, and even SNIT doesn't even invest that much in these financial or investment assets. If you check their what do you call that thing, their financial. So I was wondering where it was coming from. Why was he just sitting there panicking? Yes, that's the thing, panicking or on his, and it was SNIT. I didn't even know why, because nobody has said anything about SNIT in these times. At least I haven't heard it. So I guess people are just panicking generally and probably having some sleepless nights. As I said, I was checking how to survive a recession yesterday. So I don't know what other people are doing.
Interesting. Okay. All right. Then I think maybe you've not checked on social media. Then you are well insulated from the things that I'm hearing. Okay.
Wow.
Let's see. Adam, Serum, how you doing?
Yeah, Elikem, I'm
Adam.
good.
Hi, Elikem. I'm good, thank you. Hi.
I'm also fine, thank you. I'm glad you people are fine. You're all good. I'm glad everything is good with you. Well, not everything, but
How we go do?
Yeah, exactly. How you go do it? Charlie. Okay, I see. Courage, how are you also doing? Welcome upstage to join us again.
Thank you. Good evening to everyone.
Good evening, Courage. Okay, so let's and shout outs to Paulina. I see you in the audience. If you want to join, if you're in a position, feel free to request the mic. We'll definitely encourage your questions, which will get us thinking. So to our speakers, let's introduce this topic. I must say it is this conversation in the almost 2-year history of Money Convos that we've been having discussions. This is one of the heaviest discussions I've ever had to think about, I've ever had to plan for. We had our usual planning discussion. We couldn't wrap up. We couldn't figure out how exactly to take this conversation because we've had a discussion about the exchange program before and we don't want to have a repeat. But it seems still tensions are coming up and people have questions, people have concerns. And also it's not just about us not repeating, it's the fact that this is a very sensitive discussion. many people are hurting. Many people have their hopes having to dash their hopes. I was talking to a friend and I was like, Charlie, she said, okay, you even if it's her bond that is maturing even in 2024, you if not today, at least next year, can she get her money? Because she has serious plans. We are hearing about all the people who've retired, who had been saving for 20 years, 30 years. People are asking this question of what crime have they committed? And if their crime was trusting in their government. It's a lot of emotions, very valid emotions. People need money to pay for health bills. People need money for education. People need money to even put food on their tables. Money that they've been saving away. People are hurting, man. It's really tough. So just getting into this conversation, it's been tough for me. A tough past couple of days. Just thinking through this. Another angle of it being tough is how do we even the professionals. The investment professionals. Of course, their challenges as professionals doesn't compare well enough to people who have lost all their lives investments. But looking at it as which people can I invite to speak to this, I'm seeing that a lot of professionals, investment professionals, are in this precarious position where it's very tough for them to offer suggestions. It's very tough for them to give advice because at this point there's so much uncertainty. You could, like Mimi was saying a couple of moments ago, you say something that, oh, this is how it may happen, and then next week the situation changes. Whether the government changes the conditions or, so much uncertainty. So it's really tough to get people to confidently give advice. At this point, a lot of professionals are just telling people, you know what, these are your options. We'll explain the implications of the options, and you make the decision on your own. We'd all like people to calm down, to take a break before they make these decisions. But at least we at Money Convos, we also want to join in the efforts. We know you are scared. We know you are hurting. We know that your life decisions have been upended. But hopefully in this discussion, we can look at the implication of each choice. We'll look at what exactly is happening. What is this exchange program at all? What are the options that people are being given? And if somebody goes down with option A, what can they expect to happen? If they go down with option B, what can they expect to happen? And of course, this is no investment advice. We just want to arm you with some more information as you make your decision. And we must admit the situation is still fluid. So some of the things we may say today, and new information may come after this conversation, which we're having on 18th January, and the situation will change. But we just hope that it will be useful to our audience today. Okay, so with this heavy introduction, I guess I would like to open it up to my speakers. Who would like to tell us? Just give us a brief reminder. What is this exchange program about? In a summary form. Sarah, would you like to take that?
Okay, hi Elikem. Hello everyone. So as we are all aware, somewhere in December, government initially launched. Yes, they said they launched or announced a debt exchange program. Basically saying the fact that at the currency, the monies they owe, they would be unable to honor the terms of the agreement. So that said, they want us to bring they want you to bring the bonds you currently hold or the debt you currently hold, and then they will give you new ones with new terms. Initially, I think they were going to exchange the existing bonds for just about 4 bonds. But since 24th yes, around the Christmas break, they introduced new bonds. They said they were now going to exchange the existing bonds for 8 new bonds, and 8 and 12, relatively about 12 new bonds. The main thing that I would say, one of the main changes, that has been done is initially when the exchange was announced, announced early in December, individual investors or individual bondholders were excluded or were not eligible to partake in the program. However, with the revised program, individuals have been invited to also participate in the program, meaning that if you are an individual bond holder and you have bonds that are going to mature from, I think, February 2023, you have the option of bringing your bonds and then coming to exchange them for the new bonds that government is going to issue. Another key thing that was done was initially pension funds were included in the initial program. However, as it stands now, for this particular program, it appears pension funds are not eligible. It doesn't automatically exclude them for future restructuring, but for this particular program, pension funds are not eligible. And so what are they saying? They're saying that if you have bonds that are going to mature from 2023, right? Bring it from February 2023 and bring it, and we'll give you new bonds that will mature from 2027 up until 2033. Yes, so and on an annual, and they will start paying you interest on those bonds or coupons on those bonds from July 2024 up until the last bond also matures. As we know, interest rates have also, or the coupon rates too, have been reduced. So averagely, the interest on the bonds are averagely around 9%, 9.9%. With the 2023 bonds, especially because 2023 is just, we are in 2023. So what they have done as a form of compensation is to say that for people who submit their 2023 bond, they are going to give you upfront a 2% of the face value as some sort of compensation, right? Yes, but for those whose bonds mature after 2023, that's from post 2023 bonds, those people to have to submit their bond. I mean, they can't submit their existing bonds and receive new bonds that mature from 2027 up until 2038. So that's just a brief summary with it on it. I'm sure Courage can speak, make it more finer. Thank you.
Thank you, Sarah. That's a very enlightening expose of events, especially comparing what was there before and what has changed now. Courage, perhaps are there any gaps in any gaps you want to fill about the general concept of this debt exchange?
Well, not much. I think she did a great job. Except to add that if you look at the valuations of, or you put the numbers together, really, it looks like with this bond, it would take you, with that new arrangement, it would take you between the fourth and then fifth year to recover about 50% of the principal that government would have owed you in this instance. The variation again here with the four new instruments is that they want to introduce more liquidity from the start, where you have a number of bonds maturing each year, and then they are also trying to vary the terms a bit to make it rewarding going longer. So instead of the 10% flat rate on the four bonds introduced earlier after 2025 or from 2025, this time around we are starting from 9%, I believe, and then with an incremental 15 basis points every year until you reach 2038. And so by 2038, you would have been earning about 10.65% on the bond and not the 10% initially announced. But I must just add that we are here because the IMF demands we restore debt sustainability. After the debt sustainability analysis that preceded the staff level agreement, it was adjudged that Ghana's debt is not sustainable. And it wasn't just the public debt as we know it. They looked at all of the SOEs and quasi state agencies and the publicly guaranteed debt to most of those other state agencies and added everything together and said that, okay, in any event, government would have assumed responsibility of these debts anyway, and the books of these companies are not already looking liquid. Yeah, so they aggregated all of that, and we have a debt stock now that is about 110% of GDP, so we are told. And so the caveat or the instruction from the IMF that for us to approve your program, you have to restore the sustainability. And the yardstick or the measuring rod they are working is that by 2038, we should have reduced the debt to GDP ratio to 55%, really. And so that is what they are working with. I guess at this moment, the consideration is purely looking at the numbers and see what we can adjust to achieve that target by 2028. And you need to show IMF significant progress with that to be able to achieve their sustainability. I guess these are the reasons why governments seem to be unyielding at this point in time. But in short, this is what they are seeking to achieve. Bring debt to about 55% of GDP by 2028, and they are doing everything they can, at least from the domestic side now, to get a board level approval. Then they can approach external investors to resume or to commence the talk about external debt restructuring also.
Thank you, Courage. That's a very good explanation on the more technical side. I just want to clarify some of the information you put there. So you said now the interest that will be paid is starting with 9% in the first year. That's 2023, right?
No. So the interest schedule now still maintains 0% in 2023, 5% in 2024. But from 2025, so they start paying back. I mean, using simple term, paying back the bonds from 2027. But between 2024 going, they'll start paying coupons. So like they announced earlier, 2023 will be without coupons. In 2024, they'll pay 5% across board. But from 2026, each of the tenors, there are 12 tenors in total. To the 2020, I think the first maturity is a 5-year. So that there is a 2027 tenor, 2028 tenor, all the way to 2038 tenor. And so for each of those tenors, for the 2027 tenors, it will start paying 9% coupon from 2025. For the 2028 tenors, it will start paying 9.15 coupon from 2025 and all the way. So for each of the tenors, the longer it goes, then there is plus 0.15. So the longest tenor, which is 2038, will start attracting a coupon of 10.65 from 2025. So that is the modification. Initially, it was a flat rate of 10% across the 4 tenors. But now, each of the 12 tenors have different coupon rates starting from 2025.
Powerful. Thank you very much for that. And I'm just listening and I'm just empathizing. I'm just empathizing with the layperson who has bonds and asking, wow, will they even understand this? Will everyone get the courage to take his time to explain it to them like this, or a Sarah, Mimi, and let them to explain it to them like this? Without this kind of help, people really must be very confused, man. Really tough times, yeah. Really tough times. And Courage, just one last clarification, or more like a follow-up question. You talked about a target GDP debt to GDP ratio. That's to put in lay terms, by 2028, IMF is expecting us to get to a certain point where our finances are in good order, all right, to put in lay terms without getting too technical. What are the odds, before we get into the choice, and Sarah, I'll be looking at you to list out the choice for us, right? But for Courage, what are the odds of us achieving this target within this time? And if you don't believe it's a good time, what is a more reasonable time that people can expect? Will it take an extra 2 or 3 years?
No, my main challenge with this whole arrangement is that, you see, we spent so many years doing the things the market, individuals, civil society organizations have been complaining about, accumulating debt. In fact, it's surprising, debt accumulation is actually a topic associated with the NPP government, because it was one of the things they campaigned on seriously about the past government, that they've accumulated so much debt and there is very little to show for it. And so debt has its place, no doubt. And I'm not talking against debt. We all borrow for good reasons, really. But then to the extent where, you see, for anyone who is prudent, if you are accumulating debt, you are asking yourself how you pay it back. I mean, you couldn't possibly be taking up debt when your salary monthly cannot even go into debt service. But that was our situation. At a point, I think sometime last year, our debt service to the revenue ratio was about 78%. What it only means is that whatever tax revenue and revenues you mobilize, including grants and all of that, 78% of that was going into interest payment. So clearly, there was a journey that brought us to this level. It didn't start from that 78. It was way lower. And so we spent several years accumulating debt, and it's now an issue. And we are trying to spend 5 short years to resolve that issue. You see, we have choices. An example is that Egypt is a bigger economy than us. I think they are the 4th or 3rd largest economy in Africa, behind Nigeria and South Africa. Egypt is with the IMF now. They started a program in October, a 4-year program, 48-month or so program, extended fund facility, which is an upgrade than the program we are seeking. They got the same 3 billion from the IMF, but they are doing it for a 4-year period. Now, that 4-year period gives you a lot of time for adjustment, so that you can be a bit more patient with it and achieve the target more realistically and make them irreversible. And then you can be under the watch and supervision of the IMF for a longer period. I guess we chose to do 3 years, even though we have a debt problem to solve, because someone probably is making a calculation that if in 2023 and by mid-2024, we can front load the adjustments and make significant progress, we can point to inflation in single digits, we can point to GDP growing strongly, we can point to exchange rate being stable, and which are things you will get when you are under the supervision of IMF anyway, then probably it becomes a good campaign message going into the 2024 election. This is just me thinking aloud. And I want to think those may be the reasons why we are aiming for such a short term, a short period to want to go for this. But I felt that to make the pain less and a bit more bearable, we could have chosen a longer period of adjustment and submit ourselves to a program and regular supervision by the IMF for a much longer period, because our problem is that we go for the program, we try to exit and do all the right stuff, but once we exit, we reverse every gain we have made. When we exited in 2019, that economy that exited the IMF in 2019 is not the one to be characterized by some of the things we are talking about today, but somehow they've all been reversed. We are talking about COVID, we are talking about banking sector, we are talking about Russia, Ukraine, but we are not alluding to the fact that some of them, or a big part of it, is also self-imposed, really. And so I feel, to answer your question more directly, I feel we are trying to undo or correct the damage we have caused over several years in just a few years, 5 years, which is quite unfair. Is a reason they cannot accept or vary the terms significantly to make investors lives a bit easier. And I would have aimed for maybe a 7 to 10 year period of adjustment to try to restore this. And you can be under an IMF program. Extended credit facility could go for even 5 years if you so desire, so that you can get a longer supervision. It only means the funds you've applied for may not come quickly, so they would have to stagger it after every review and all of that. But if that is what we need, so that life is a bit bearable for people, and then we can restore the macros, so be it. And so I think we are rushing it. We are rushing it potentially because someone is working some numbers and feel election is in the corner, so let's try to do it quickly so we can stand a good chance, which is quite unfair if that is the context within which we are doing this. I feel a longer period would have helped so that the adjustment could have been a bit steady and slow.
Wow. Okay, all right. A longer adjustment period would have been fairer and more reasonable. Wow. Okay. Thank you, Courage, for sharing that. Okay, so the timeline really matters because once we understand the timeline, we can understand our choices better. Because the government effectively is saying we can't pay now, but let's modify the terms so that in future we can pay. If we know how long it will take for the government to reasonably recover, that'll help us understand how soon things will get back to normal. So, Sarah, what are our options?
Yeah, hi, Elikem. This is actually a very difficult question to answer.
Hello.
You either accept it.
Sorry, Sarah. I think you broke off for a second. Can you start
Yes, I
again?
was saying that what are the options is actually is actually a difficult question for me to answer because as to whether there are options. The main option per the program is you are either submitting it, accepting the offer, or you are not. Unfortunately, as it stands now, we don't have a lot of information on what happens if you don't. Per the FAQs that was released by the Ministry of Finance, I think the wording there just says that if you don't participate, you don't benefit from the program. As to what the implications are, it's a bit difficult to tell because it could mean that government could default on the existing bonds. It could mean that the existing bonds would be taken off from the trading platform, so will no longer be liquid. So it's a bit difficult. As it stands now, the deadline has been extended to 31st January. So really, I don't know how to respond to that. It's take it or leave it. If you don't take it, you have the option. If government event decides to default, then you have the option of seeking legal redress, just as any contract going bad. You have the option of seeking legal services. So that's it on my side.
Interesting. So, immediately, prima facie, on the face of it, take it or leave it. That's exchange or don't exchange. And it's interesting. If you don't act, you are effectively not exchanging, and that's an option. And it's between a rock and a hard place, right? Neither option seems palatable. Neither option is palatable because it throws all your plans awry, means you can't get your money. In fact, until you even have to make these decisions, you're even trying to pull money out of your investments and you really can't access that money. Putting in withdrawals and the cash is not coming. So, it's tough. Okay, so
I just
yeah.
sorry, just to buttress the fact that it's really tough. I have a client, a 75-year-old client who has a bond that is going to mature on the 6th of March 2023. This is a client who bought the bond when the bond had less than a few months to maturity, right? Because he's 75. And you tell him that you'd have to exchange your bonds from 2027 to 2038. And this is a 75-year-old man. It's a very difficult situation or a difficult choice.
Yeah, it's a tough one. At the time he bought it, it was a short term, just a few months to mature. In terms of time, it's like a treasury bill, but it was running for longer than that. So now it's being thrown in the mix. Tough one. Okay, all right. So let's start talking about implications. Again, this is not going to be investment advice. It's just so that people can have a good sense of, if I choose this, so this was possible to happen. If I choose that, this was possible to happen. Again, things are fluid. Certain decisions that were made in December or certain offers that were made in December, now they've been changed, terms have changed. So you may have to keep updating yourself. But based on the information we know now, what can we see happening? Let's say somebody exchanges their bond. Mimi, Edem, let me come towards you. In lay terms, how does it affect? How would it affect them, or what would they get?
Yeah, I think Courage explained what is likely to look like. And I think the new arrangement also takes into consideration when the bond is maturing in terms of the coupon payment. So it's not going to be the same for everybody. But what's going to happen is that I feel like the value of your money under the previous arrangement when there was no debt restructuring is going to be significantly reduced through this whole process because of time value of money. Because remember that the principal, whether you were what do you call it, the bond was going to mature in 2023, even though with the 2023 they are given 2% of the face value, whether I was going to mature in 2023 or 2025, now it's going to be paid from 2027 going into 2035. So, I mean, I saw an article of someone who had broken down if you had 100,000 and how you be getting, I think, I've forgotten the schedule, but I think it was like 9,000 a year. It had taken into consideration the percentages per year. And I felt like that was very small. By the time you get the full 100,000, I mean, you would have lost value. And I think that's the main concern for most people. Also, the fact that, people planned liquidity, had liquidity needs and planned with these bonds, knowing that even if I'm getting, if my money is maturing in, let's say, 2026, every 6 months I'm getting this, and based on this income I'm expecting, I'll do this and that. So this could be for individuals, it could also be for institutions. Now that money is not coming as expected, which poses a lot of problems, especially with those that were heavily invested in bonds. So we've seen some retirees crying over, how this is going to affect them in terms of being able to afford, medical care, etc., because this was their main source of income. We've seen, I saw something out there that 17 out of the 23 banks are going to have serious issues with I've forgotten their required. Sorry, I've forgotten the term, but the capital that is required, and so this is
Capital adequacy, you mean? Capital adequacy.
Exactly. Yes. Thank you. Capital adequacy. So this is sometimes those who didn't buy bonds think that, they are not going to be affected by this, but it's a huge issue. I mean, it's a huge problem which would affect each and every one of us, whether directly or indirectly, will all feel the pain somewhere. So let's brace ourselves for the times that that is coming. But let's hope that we get better terms. But I think the earlier we get this thing, I mean, some information, like Sayram said, the better, because it's very difficult to give people advice on what to do. They don't even know, even T-bills where people used to feel comfortable about a month ago. I don't know why, but all of a sudden people are not comfortable. I think there was some communique, and since then people are not comfortable. So it's making it very difficult for people to make the most out of their money, and keeping the money in your bank account by the time you realize it's finished. So just tough times. Let's hope we get through this one.
Interesting. The latter part of what you said about treasury bills, it just got me thinking that sometime in the future we'll have to have a discussion on Money Convos about where would be reasonable for people to invest moving forward. It's because I can imagine some people are saying that they won't invest at all, but we'll have that conversation another time. Back to this. So in summary, looking at the implications, you go with the debt exchange, or you submit your bonds, you get the new bonds, you'll be getting your money small in return, instead of getting the money all at once. You just be getting it in drops. You wouldn't earn any interest in the first 2 years. From 2025, you earn 9%, and then next year, 2026, 9.15. The interest will be going up small by 0.15%. And from Carriage's analysis, in 4 to 5 years, you would have recovered 50% of where your money was at in the first place. That brings us to another point that Mimi raised of the lost value of your money, with inflation at 54.1% for December. So that's for 2022, 54.1%. That tells you how much of your value, the real value of your money has already been lost. That means effectively, on the average, if you could buy 10 items, now that same money can buy you only 5 items, in a simplistic way to look at it, because the cost of everything has gone up. Wow. Really dire times, man. Really dire times. Well, I have a question, and Seram has gone down. Let me bring Seram back up, and it's about the secondary market. Okay, I think I've heard a lot of people talking about these things, but I don't hear anyone talking about the secondary market. My question is, assuming we cross this hurdle, the whole settlement is done, we all know the new bonds, they are running. Isn't there a place for the secondary market such that the people who fear that they are old, or regardless of their age, they will have to wait too long for 10, 12 years to get their money back? For those people, can't they sell it on the secondary market? That's the first angle. And I have another pretty innovative idea I hope someone will pick up on. But let's tackle this part first. Can anyone speak to the secondary market and its ability to handle the situation for people who need their money faster?
Yes, Alikem. So ultimately, the market will correct. Once the macro start improving, once the IMF program start and the adjustment start, the market conditions will improve. And that is where I just want to sound that, yes, monies would have been lost, but let's also look at it from a different angle. As we speak now, we are all earning to get our whole money back, 20%, 30%. And when the maturity falls due, we get that. Now, let's assume government finds money to even pay off those ones. Is it with our economic situation now, our debt level now, and where we are, times could be very hard for a long time, and we need an adjustment. But without pushing through this domestic debt exchange, the government cannot even start the adjustment in the first place unless they want to do it by their own, which will not win market confidence and all of that. So there could be light at the end of the road. I see it from a much broader picture where if we succeed in doing debt restructuring, whatever form it will take, local, external, and we do the debt to the levels that are being envisaged, we have restored stability we cannot dream about in a long time. That could be a basis for all of us to probably enjoy going forward, have more stable market, it become more open, more flexible, like your South Africans and the likes. And so I think that the consideration should be that we need to look at certain classes like the pensioners, as Elikem is referring to. Some people are above 60, some people are a few years to 60. Can we all agree that this program has a 15-year span? Anyone with maybe 10 years or so to retirement should be excluded. If you are an individual, anyone from 10 years to retirement and those in retirement to be excluded from this. Then the rest of us can, as a whole, negotiate what terms we feel is more acceptable than what is on the table now. When we come to that consensus and the debt restructuring is pushed through, the secondary market becomes active. And then at the slightest opportunity, when prices would have improved a bit, those who want liquidity can trade off those bonds. The risk of not tendering, as we speak, is that the Bank of Ghana has already issued instruction to the commercial banks that you cannot use the old bonds in computing your tier 1 capital. You cannot use it for repo transactions. You cannot use it as a collateral for most of the things you do previously with me. So already one market for those bonds now is shut off. If you hold the old bonds, you might not expect a bank or an insurance company or such, because SEC and others have also said similar things to the fund managers, really. And so there are rules around it, right? And so you may not even be able to exchange it. Then you have to look for another individual who is willing to take that risk. That will be more difficult. But if we all push ourselves into it and push for more improved terms and accept it, what it does is that ultimately the bonds become tradable again on the secondary market, and then the price recovery can begin, so that maybe in a year's time or a year and a half's time, you can be able to sell your bond close to par, even if not par. The only downside to that will be that should maybe in the next 2-3 years, government issues a new bond, maybe at 20%, at 15%, whatever rate may be, then it leaves everybody with no reason but to rush for those ones rather than these bonds with very low terms. And those are, I believe, in the negotiation, what we must be putting across, putting some ban or some bar or some clauses on government that prevent them from doing anything that makes these new bonds inimical. And if we push it that inimical to our ability to trade these bonds as they are proposing them now, and then we can have a common market that can actually lead to price discovery ultimately going forward. And so I feel
Courage. Courage, not to cut you off. I just want to give some context for the question that I asked. I know that I can imagine that there are way better ways this could have been handled. But for the conversation we are having, we are looking at it as investors who've been given two choices. I don't think like there are other platforms where people can try to renegotiate. The various institutions can do that, but for we here, we are faced with just two choices, right? And we are looking at going down that path. Currently, if we go with this path and we take the new bonds, I'm asking about what would the secondary market for those new bonds look like? That's what is my ability to sell those bonds if I don't want to wait till they mature?
Immediately they will not be easily tradable, but and that is what I'm trying to allude to, that once the macro starts improving and assuming there are no alternatives which are higher yielding, then you can begin to see some activity in those bonds now, where people who have resources are trying to accumulate some, and then you can find windows to sell. So ultimately, I think in a year or two time, once the macros begin to correct, inflation come down significantly, you may begin to see activity in those bonds, and that may offer even opportunity for those pensioners and whoever wants liquidity to exit. But that will be on condition that there are no alternatives that offer superior returns to investors than these bonds. The moment corporates start issuing bonds in volumes, and those are blue chip companies, people assess to be okay, and there is risk worth taking. The moment the sovereign start issuing again at rates that are more attractive, the moment T-bill yields remain elevated above these yields we are seeing on these bonds, there will not be any incentive. Those guarantees we cannot get now. And that was the point I was coming in, that maybe for those having the opportunity to meet government now, those could be some of the things they could be pressing on. But I understand the context. So my simple answer is that they could be traded over time, so long as there are no more attractive options on the market.
Okay, great. Thank you, Courage. Yes, Aram.
I want to take your job and ask a question.
Okay.
I'm curious, Courage. So, considering that as it stands now, this current program or offer terms exclude pension funds, right? I'm trying to figure out what happens to the bonds that the pension funds currently hold if the existing or the old bonds are expunged or are no longer tradable. Does it necessarily mean that the pension funds have to hold the existing bonds till maturity? How will government decide to pay the pension fund board holders and maybe exclude other people who did not participate in the program?
Good question, and I guess is the reason a lot of people are holding on to their bonds and do not want to tender them. I think the question is, on what terms will government pay pension funds their coupons normally, but then not pay the individuals, and whether that will not amount to breach of contract and legal actions and all of that. And then the other leg you are raising now. You see, the risk here is that, and pension funds do this anyway. Pension funds do not exactly buy bonds to trade along the way. I think the usual thing is that they are holding to maturity. It is perhaps when there is an attractive opportunity that they may want to flip at some point. But then normally it is to hold to maturity. And so their exemption for them will not mean so much because they could hold on to these bonds till they mature. But for an individual, the difficulty becomes, even if government is current on coupon, and then it gets to a point where you need some money to attend to something, and then you want to flip your bond. The question is, how quickly can you be able to flip it, if at all there will be an opportunity to do so? And then liquidity becomes a problem. Those are the unknowns that makes the decision quite difficult. And so I believe that we have a contract with government to buy the bonds that are existing now on certain terms, and it is a voluntary exchange. So the decision to exchange or not exchange is per your analysis and conclusion. If you decide to hold it, government is duty bound to pay you. If they not do so, they've defaulted, and there are consequences for that. Really, you can press charges in court and get favorable ruling because there is a contract for it, really, and all of that. But then the question becomes, if you have to exit those bonds, will you be able to do so? That is where I feel there might not be a market because of what the regulators are saying to their players, which limits the options of who can buy those bonds off you. For the pension funds, it's their modus operandi. They hold these things to maturity anyways, so they might not be overly worried. But for an individual, it could be an issue.
Charlie, you know the matter is very serious when a fund manager herself is asking an economist the question about the situation going on. The matter got very, very hot. It is a very, very tough situation, man. And again, I say, like, and we have Edem here. Edem has gone through, the securities courses and all those, but can you imagine if we are sitting here, we are finding it tough to understand these situations? Edem, how about the layperson?
Yeah, Elikem, that's the major challenge. And I mean, listening to Courage with all the nice jargons when he's throwing it about, and then it can get so confusing for the ordinary person. For a lot of people, all they know is that I had 10,000 cedis. I bought some bonds. I'm expecting 10% or 15% interest, and every 6 months I'm supposed to pay some coupon. And then maybe after 3 years or 5 years on maturity, I receive my money. Everything in between that is going on right now, it's kind of just turning our eyes around the place, So it can get really, really confusing. But I think for me, one thing I understand is that whichever way, there's going to be a pain, whether you take that in or you don't. I think we will just have to choose the pain that we are comfortable with. That's how I see it.
Charlie, interesting. Even before we have to choose the pain, we are feeling the pain right now. Wow. Charlie, so let me ask one more question. So we've talked about option A, exchange your debt, right? We've talked about that, the various implications on the pension sector. We've even indirectly talked about what's going to happen with the banks, right? Let's look at, so we'll be switching over to the other option where you don't take any action, you don't exchange. We'll get to that in a second. But Courage, one last question is this. Is it possible, still with the secondary market mindset, is it possible that we can start treating our bonds and mutual funds, not just bonds, but mutual funds also, because the mutual funds themselves are not quite liquid right now. So any other instruments that is kind of majorly linked to this, can we start treating it as currency? Why am I asking this question? Right now, if you want money from your mutual fund, you can't, like, you get your money. They are talking about mark to market some weeks ago, but even when they mark to market, you lose your value. You can't even get the cash, right? Same with bonds. You can't get the cash. People have hospital bills to pay. Let's say someone has to go and do a surgery, and the hospital is going to charge 50,000 cedis to do the surgery. Is it possible that we can get to a point where we understand that, okay, Mr. A will say that, hospital, I have bonds, okay, go to this institution. This is my CSD number. I'll write an instruction. I'll transfer 50,000 cedis worth of bonds into your account as settlement for the payment. Please cure my sickness. Then just one more second. And then you ask, okay, so what's the hospital also going to use the money that's bond for? They also have suppliers that you have to settle. So they can also tell those suppliers, well, people have been giving us cash, and you know what's going on. No one is really getting cash for their bonds. So I have to pay you for some syringes you supplied me. Here it is. Here's some bonds, maybe 10,000 in bonds or something. And then it keeps going on. And then we try to make the bond side, like, or the bond or those underlying securities become currency. That may reduce the pressure that is going on in this industry. What do you think as an economist?
Well, money performs the role of a medium of exchange because it's acceptable. And that is one of the qualities money must have. You must be universally acceptable. So there should not be an instance where, if you say you are selling water for maybe 2 cedis and I give you 2 cedis, you reject it. To the extent that it would have to be the discretion of the person whether to accept it or not, then it doesn't become money and it's not easily exchangeable. I mean, for some people, they know nothing about bonds. They've not heard it anywhere. Even if they heard it, they don't know what it is. The hospital example, and you actually said it right. So I decide to transfer my bond, assuming they are willing to take it. And they also want to go buy some syringe and some supplies, some medicines and stuff like that. And they go and the supply says, I mean, what do I do with this? Then what happened? You have something on your books that you do not have need for. Is a reason why the banking system have the arrangement where if you need liquidity, when your clients come withdrawing money, you don't give them bonds, you give them cash. And if you need cash, you go to either a colleague bank to borrow cash. In return, you give them some security, some bonds, some treasury bills as collateral, and you get cash to pay your clients. Or you go to the Bank of Ghana and borrow some money and then deposit your securities there as a collateral, so that you can ultimately give the client what they need as a proper medium of exchange. So those assumptions, I guess your mind is quite fertile. Those propositions may not work because not everybody would be willing to accept these bonds, not even when they were so attractive, not now that there is so much noise about it. And it's a reason probably trading levels are very low on the market, because the offers are there, but there are no matching bids. People just do not want to have anything to do with it. And so before you even want to transfer it, the person must be willing to accept. And I doubt that acceptability at this point, not even when it was quite attractive. So the options are limited. And that is why I feel as a people, well, maybe I'm jumping the gun, but I see the sense that the general sentiment around is everybody is saying no more investment, no more investment. It's making the job of an investment banker, a salesperson, a fund manager very difficult. And there is a risk people may lose even their jobs. Because why would your employer keep you and keep paying your salaries if you are not bringing in anything really? Those risks are there. But I guess the conversation now for us should be that you could have been walking down the street and lose 1,000 cedis, which is equivalent to something you put a government of Ghana bonds. In this case, it's not lost, but the time to get it back is prolonged. How can we survive here from here on until that money comes to? I think that is the conversation we should be having with our clients now, so that they get to understand and then we actively find options for them, because it is equally very suicidal if they decide to stay off. But exchanging bonds for goods and services at this point, even if they were attractive, I think is may not be accepted.
Okay, that's interesting. So it has the bonds have to be universally accepted. So that just gets my mind going again and say that maybe people can start doing some business, set up financial institutions where like discount houses where they can come with some cash and then buy people's bonds off them, of course, at a fee. It's like treasury bills back in rediscounting or discounting your treasury bills. You take a hit if you need your money earlier. Interesting. I hope people do.
I agree with you. I agree with you, Elikem, on that. And it was a conversation I was having with a colleague earlier today that even in the midst of the chaos, there is still opportunity. You know, let's assume interest rates of 20%. And you have 100,000 bond. It will take you 5 years to double your principal, assuming you are not rolling over the reinvesting the coupon and all of that. It will take you 5 years to double your principal. Now bonds are trading 50% discount, 60% discount, and people are happy to sell. So if like what you just said, if you have a certain finance house or discount house, rediscount house, where you say, okay, all those who want to sell, assuming you have some huge money there, you say, all those who want to sell, you bring it out, buy. And even if you exchange, you would have been paying half the price of the face value of those bonds for the full face value. And so even if you don't intend to hold to maturity, your hope may be that in 2-3 years' time, the market can correct, even if not to 100%, maybe even 70-80%. Then you flip those bonds, you'd have been making good money. And so those are opportunities for people who have money to try to make money as things stand, so that those who want their liquidity can have it. Unfortunately, not many are thinking along those lines. And so it makes it quite difficult. But those are things we could do so that you buy those bonds at 50% their prices now, 40% their prices now, in 2, 3, 4 years' time, where you would have been receiving the first principal payment or amortized part of the bond, you would have been earning what you would have earned if you bought a 20% coupon bond that was paying you coupon for 5 years, really. So you wouldn't be worse off if you bought them now. So I see opportunity in there for everyone who cares to take the risk.
For everyone who cares to take the risk, major caveats. Okay, all right. So I guess perhaps I should start talking to my millionaire friends and my boys on Wall Street, boys and girls on Wall Street. Okay, interesting. Okay, let's move to the other angle, and I guess there's not so much to say about it on the other choice, right? Or it's all up in the air. And Courage, you alluded to some of these points. If I don't tender my bond for exchange, what's going to happen to me?
Is that for me?
Well, let's first, in fact, before I come to you, while you ponder over that question. Hi, Prince, how you doing? You've been quietly listening to this, and I know that you've been in a pensive mood for the last 1 week on this matter.
Welcome, I'm doing fine. Yourself?
I'm great, my brother. I'm great. Perhaps you've heard what we've been discussing so far. I'm sure people have been engaging with you. In fact, I have 2 princes in the audience. Yes, yeah. So, do you have any thoughts before we move on to the other angle? Any words of encouragement for our fellow Ghanaians who are going through it these days? You know that you are. Is it the person in the Bible? Is it Barnabas? He's the son of encouragement or something like that.
Oh, Elikem, why are you like this?
Now I'm putting you on the spot. Please tell our people something to try to uplift their spirits, because it's not.
Oh, for me, I think I shared something with my audience today. I was saying that a lesson for all of us to learn is that every loss there is a victory. For every sadness, there is an element of joy. And you may think you have lost everything, but there is still hope. Right. So I think Courage has said so much about the whole thing. Myself, I have my own reservation with regards to certain investment portfolio I hold, and the situation as of now. So we are all in it together. We just have to keep hope alive and believe that the IMF money will come in and other things will, at least inflation bits will stabilize for to take over the market. So I believe something positive will come out. Yeah.
Thank you, Prince. You are keeping the hope alive. Something positive can come out of this. Okay, back to our lecturer for the day, Courage. You have become the de facto lecturer. Please tell us what's going to happen if I don't exchange my bond, or what can happen. These things are fluid, so what can happen
if you don't exchange, or when you exchange,
or if you don't exchange your bond?
Okay, so if you don't exchange, a few things could happen. Already government has exempted pensions, and so it means that government is duty bound to honor the obligations to the pension funds. They'll pay coupons when they are due. They'll redeem principals when they are due. I don't know if there will be the option of rolling them over, but I think we'll get there, and then we'll see how it's dealt with. There is not much clarity on that as we speak as to what they will do when those pension funds, what they are holding, falls due. So you can hope that the same way that they will treat the pension funds, they will treat you also, so you can get your coupon. And for the passive investors who want to hold until maturity, then you can be chopping your coupon coolly and hope that when the maturity falls due, government will find money to pay you. The other thing that could happen is that maybe they work the numbers. Pension funds have about 13 or so percent, thereabout, of the total portfolio, and maybe they've done the numbers and think that, is it 13? I think it's slightly less. I mean, they've done the numbers and realized that, okay, maybe we can handle these ones. But then if individuals are under, then the total is going towards 20% of the portfolio, and maybe that becomes a bit too much. And there could be potentially a risk of default where maturity falls due or coupon falls due and government says, I do not have money. By the way, a default doesn't mean I won't pay you. A default only means that, okay, I owe you, it's due, but I'm unable to pay. It's some of the clauses in that what's the name? Prospectus says that once some of those conditions are breached, investors have the right to call the bond immediately. And so it opens the government to most of those legal actions. And if you have the might, you can pursue it and all of that. It could be windy, but ultimately, of course, you are sure that you get victory because you have a binding contract to go through. Now it becomes how quickly can you get your money back. It could also mean that they will be paying coupons, but then principals, when they fall due, there might be an issue that they might automatically force you to roll it over. But then again, you want to ask yourself, why will government say people should accept lower terms for the new bonds only to have no consequence at all for those who refuse to tender? Not that they are doing anything wrong, but why would someone voluntarily tender a bond only for those who refuse to tender to enjoy what everybody would have enjoyed? It makes those who tendered a fool. So I'm inclined towards the possibility that those bonds become a bit more illiquid. There are chances there could be default. And to be very honest, John Kuma said it, even if it is unofficial. But when John Kuma first talked about domestic debt exchange in the form he talked about it, people thought it was ridiculous. But then it turned out to be exactly what was rolled out. He already gave us a hint of what they were thinking about external debt restructuring. So I guess what he said may not be far-fetched, that you may be on your own if you do not tender. And it might not be deliberate, but it could just be that the resources are not there to honor the obligation. And that is why I feel not tendering, while you could hope for the best, it can actually also turn out to be the worst. And that's why I personally, and I'm not making a recommendation for anyone here, personally for that kind of uncertainty as to what is going to happen, at least there is some commitment that we will pay on the new debt. There is some commitment that I'll keep getting my money, if not even the interest, the principal. And so I'm inclined towards saying, if I can get better terms, fine. But if not, I'll rather play it safe than not exchange and not know what will happen thereafter. So that's how I see it. Not too clear cut, but there are many possibilities, including either you could get your principal and coupon and nothing happens, or you may get your coupon and maybe principal may not be paid. Government will go into default or force you to roll it over, or you could be in default on both. At some point, it might also be hampered. So that is my thought about it. I would love to hear the fund managers to how they think about it.
That's a very powerful explanation, right? And again, to rehash, this is not investment advice. Carrie just gave his own personal towards the end, how he is thinking about it as an individual and how he would make his decision. So yeah, Sarah, how about you? What do you see as the implications of not tendering your bond? Mimi, stand by. You can't run away from this.
Yes. I think that I'm aligned with I think what I shared earlier was sort of aligned with what Courage is saying. The options are really not, or the consequences have really not been laid out clearly by government, and I know that is deliberate. But as Courage rightly said, if for those who decide not to tender, I also believe that it would be difficult for government to kind of not penalize them, because it will be difficult for government to be paying them the interest, their coupons due, their maturity due, whereas people voluntarily tendered in their bonds. So on that front, I feel like the risk is higher when you don't tender, but then again, it boils down to your individual risk appetite. If you think you would take the risk and wait it out, fair enough. If you think you cannot take that high risk, then in my opinion, I would on that front tender in, because at the end of the day, I would rather have 50% of my money, the certainty of 50% of my money, than rather be in limbo.
Sarah, please repeat that last sentence, because I was going to give my opinion and it's exactly that.
I said I would rather have 50% certainty that I'll have 50% of my money than no certainty and me being in limbo.
Okay. Again, not investment advice, just Sarah's own opinion and how she's thinking, and I am very much aligned. I would rather have some clarity on what could happen, and I know that, okay, if I tender in my bonds for exchange, these are my options, and I can work my way around it. I have a couple of months or years to plan for how I'll adjust. But if I don't exchange, all bets are off. I can be a part of a class action lawsuit, or some people will go and sue without me and they will get their money before me, and then when it's left with my turn, I don't know what's going on. Or maybe the government will just go ahead and pay everyone, and then too much already. People are already stressed. People don't know what's going to happen with their jobs. Do they want to add this headache of thinking through this? Wow. But yeah, guys, we've been having a conversation about to exchange or not to exchange, Ghana's domestic bond exchange program. A lot of people have bonds, and they have a decision that they are being faced with, to exchange or not to exchange. Some people may not even have bonds, but you invest in mutual funds, and I know it's this part of what makes it really difficult for me sitting here in Money Convos. We've been telling people invest for years. People have listened to us. I know someone in the audience got to increase her tier 3 contributions steadily over up. Her private investments gone up, investing until it got to this point. And I feel like, and some investment professionals are feeling, "Hey, did we really lead people down this path?" But our concerns are nowhere near the other people who are worried about how they will go and withdraw money to go and feed their families. The Mason Courage gave this example some weeks ago on 21st December. Go and listen to that episode. Is the CD out of the woods? So listen to that episode again. It's like the Mason waiting for you to remove money from your investment to come and buy blocks so that he can do some work for you and go and feed his family. What's he going to do? No one is escaping from this. 20-year-olds, 30-year-olds, 40s. In fact, the people who are 50, 60 and above, it's so obvious. Our uncles, our aunties, our parents. It's really tough. But as we are thinking through this, I hope this conversation has helped you with your options. If you have bonds, and even if you don't have bonds, thinking through other investment decisions. You may have friends who have bonds. You may have friends who don't know, but everyone's just talking about what's going on in the economy. You don't know what's going on. We've had a couple of conversations here on Money Convos all over the last couple of months, especially from November on this topic. We've published our podcast. You can check in the tweets for this space. I responded to someone who made a comment, and I've alluded to a link that you can go to see previous recordings. Follow us on or subscribe on YouTube. We've posted all those conversations. We schedule and we record these sessions, as you can see. Hopefully tomorrow or by Friday, this particular conversation will be up on wherever you listen to podcasts and on YouTube. So you can go and play it back if you joined late and you missed anything. It's been educational, even for me as a professional, going through all these, all the knowledge I've had, all the 7 years of investment experience. There's still always some things to learn. This is an unprecedented experience. People are going through unprecedented emotions. But I hope that Courage, Seram have been able to give you some more information to make your decision. I don't have any more questions on this. I don't want to conclude with a suggestion of what you should do. But if anyone has any other thing to add, just send a DM, reply to the tweet or something. I could ask you a question last minute. In the absence of that, I'll just pass it around to and maybe ask Edem or Mimi what their thoughts are after hearing all this, and then we can call it a night. So, Edem, any thoughts on what you've heard so far?
Yeah. So basically, we know we've been talking about bonds and all of that, and I just think that everybody should be aware that one way or the other you are affected, whether you invested directly or indirectly. And for those who even haven't put an amount of money maybe directly into bonds or mutual funds, even the institutions that are around, they are all some way, somehow affected. So it's a very, very serious matter that I think that we should all spend time to really ponder and decide which way we want to go. And as I said earlier, it's just a matter of which kind of pain you want, but whichever way, there will be some pain. But hopefully, we hope this can get done with quickly and let some stability enter into the market, which will be much, much, much better for all of us. Because with this kind of uncertainty that is going on, it's just worrying. But hopefully, when the markets calm down and things stabilize, we can see our way much more clearly. And then going forward to when we are investing in certain things too, we will have it in mind that this can happen. Either to, it was always said as though when you give money to the government, or you can go and sleep. But now we know that this can happen. So going forward, maybe when we are talking risk-free again, we'll think twice. Thank you very much.
When we are talking risk-free, we'll think twice, Charlie. But yeah, Thank you, Adam. We are all going through it, man. We are all going through it. A quick question that has come through. And Sarah, I think this is closer to your space. Mutual funds, collective investment schemes. Are their fund managers also having to make a decision to exchange or not to exchange?
Yes, Elikem. I think it's the exchange or not to exchange is across board. There's no, apart from pension funds, there's no one exempted. But at least the good thing with not good, the positive thing is that this new structure allows some more liquidity, and also because of the 2% what's it called, the 2% you get on your 2023 bonds, I think would be good for the mutual funds who have 2023 bond maturities. And then the fact that coupons will be paid from 2024, and they'll be paid every year after that, also again brings some form of liquidity compared to the initial offer. Also, in addition, the fact that the accrued interest is now being carried also being incorporated in the bond. So yes, it's across board. But I don't think the fund managers have, or I don't think the fund managers have so no one really has so much of a choice. So yeah, I think the fund managers are all going, especially for the mutual funds. We are all hoping for favorable terms, but I think they are in line to accept.
Well, okay, all right. And I just want to quickly correct something you said. I think you said coupons will be coming from 2024. I believe they'll start from 2025, right? Not
No,
2024.
from 2024 actually, from July 5% from 2024.
Okay. Courage, you can confirm
Yes,
this,
that's
right?
correct. That's
July
correct.
20.
We'll pay 5% in 2024. Then from 2025, it will be 9%, 9.15, 9.3 thereabout for each of the tenors.
Okay, great. Thank you for that. Okay, good. See, I'm on top of the matter. All right, great. So yeah, benefits. So even with the indirect investments, at least this plan brings some more liquidity. So the withdrawals can be
Did you hear me?
managed. Yes, I heard you. You confirmed that July 2024 coupons will start then. Yeah. Okay, great. I don't have any more questions. We'll just take, I guess, the final words from Mimi and then Courage, and then we call it a night. Mimi?
Yeah. So what I think is that as an individual, before you take a decision, see an investor, see a professional, and how that would affect you specifically, and also take into consideration your own needs. Some people may have a lot of money diversified elsewhere and probably may have the ability to wait and see what happens with what they have in bonds. Others may not have that flexibility. And so speak to your advisor and look at the options available, and then choose. There are those who are also trying to say that let's not agree so that we can put pressure on government to change the terms. I don't know how that will go, but as an individual, just see your advisor and then let the analysis be done and see whether it works for you or whether you don't mind, letting it go. I think that this thing is technical. Things keep changing, so let's all be interested in what is going on. Like Adam said, everything is affected: banking, insurance, a lot of organizations, financial institutions will be affected by this. So let's put our ears on the ground to know how this affects us. You may not have bonds, yes, but you have maybe an insurance, you have money in the bank and all that. I'm not saying that that's going to be affected for you to go and take your money and put it under your bed. I'm just saying that try and be interested, because it affects us directly and indirectly, and even as a nation, it affects us. So let's try and be interested. I think we should be having more of these conversations till this thing ends. We need to be educated, because even me, I'm not from the technical side, but I have to keep on listening to so many conversations, and it's still not 100% clear. So let's keep on getting interested in these conversations so that we know how best to position ourselves.
Thank you, Mimi. So stay engaged, seek professional advice. All right. Thank you, Mimi. So, Charlie, you've been our professor for today. Any closing comments before we call it a night? Courage, if you are speaking, you are muted. Okay, well, I'll do an advert while we wait for Courage to sort out his side. But yeah, again, I mentioned earlier, but remember, we are on YouTube. You can play back our conversations. We publish the day's recording within a day or two. So expect it by Friday. Also, past conversations are live, so you can go listen to them. Sundays, we post any older ones that haven't yet been published. So do follow us on Twitter, Facebook, Instagram. Also, we were talking about speaking to professionals about advice. If you're a woman, you want to engage with Investment Friend on Instagram. That's where Mimi and Sayram do personal finance coaching. You understand? Over here at Money Convos, we do more of the discussions. There they do more of the in-depth one-on-one conversation. So you want to go and follow. All right, great. Courage, you can just request the mic so that I bring you back up and we call it a night. Okay, there must be some technical issues on Courage's side. So, well, in the absence of anything else, we just call it a night. Thank you so much. I really appreciate your time. In these tough times, everyone is hot. People don't have time. People are trying to work harder to make some more money to plug in any holes. I really appreciate your time in the middle of the week. I hope to catch you soon. Next week, same time, 6 p.m. GMT. Just engage with us on social media. Do take care. Have a good rest of your week. Bye-bye.
Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse, and Facebook. And subscribe to our YouTube and podcast. Do tell a friend about Money Convos so we all become wealthy together. Talk to you soon. Bye.